Okay, let's get started. Again, thanks for joining us. As I mentioned, Harley unfortunately couldn't make it for today's webinar, but he's produced a fantastic set of slides. I've got a very nice briefing, and I'm looking forward to getting into it. So today we will be looking at the economic viewpoint. Very quickly, as always, a little bit about Creditor Watch. We've got a nice slide here showing our product suite, an end-to-end credit management solution with the ability to onboard automatically through Apply Easy, assess your customers and analyze them on an ongoing basis using a various range of reports, ratings, and other products. And of course, we're big into automation. If we can make real-time decisions happen for you, if we can push data directly into your ERP CRM system, we're really excited and motivated to do that for you. 50,000 customers across Australia utilizing Creditor Watch, and we provide reports on every company or business in Australia, including proprietary limited companies, trusts, partnerships, and sole traders, those unincorporated entities that are sometimes difficult to report on. Key highlights there. I won't touch on this too much. As always, we are recording the webinar, so you can come back and have a look at these key highlights if you'd like. It's just a nice way for us to sort of validate why we can sit up here and talk about and make predictions. We back ourselves because we've got a huge amount of data and customers providing that to us, primarily from what you'll see there on the bottom right-hand side, 50+ public, private, and government data sources. So let's get into it. What is there to like in early 2021? So Harley shares my sentiment. The back end of last year, I did an interview and they said, what are you most looking forward to in 2021? And I said, positivity, that's my word. I'm really impressed with the way Australia has dealt with COVID, both from a medical and an economic perspective. And we're certainly in a much better position than anyone expected, particularly looking back into the middle dark months of 2020. So Australia's economy began growing again in the September quarter ahead of an earlier feared schedule. In fact, numbers just out for the December quarter showed a 3.1% GDP increase, which is just fantastic. And that is likely to increase for some time. If we just look at one comparison, the United Kingdom's economy contracted at its largest rate in history in 2020 and will continue to fall through the March 2021 quarter. They are, however, doing a great job by the sounds of things at vaccinating large parts of the adult population. So that is certainly a positive. Australia's unemployment peaked at a much lower rate, 7.4%. Than was broadly expected. We were sort of up there at the 9s, maybe even 10%. So that's really great. And of course, 6.7% the unemployment rate for December 2020 was substantially lower than earlier feared. Retail sector is coming back despite those lockdowns that we have seen in Brisbane and Melbourne and also in Perth. We will look back at that in a little bit. Consumers are ultimately cashed up, and that will benefit retail and wholesale trade amongst other sectors. We know that's a really important bellwether for us to show good progress and growth within the economy. The business sector, while struggling, is in better shape in early 2021 than anticipated, as I mentioned that, and our data certainly reinforces this, and we will have a look at that as we go through the presentation today. The COVID shock. So as we've seen here, there were big decreases. Of course, March quarter even went down, despite the fact that COVID only hit. This is March 2020, of course. COVID only really started to bite in mid-March. June was a disaster when you look at this, but no surprise, and great to see that we only saw those 2 quarters of negative growth. We've seen subsequent growth through September and also the December quarters as well, and that is expected to continue. The biggest unknown for the business community in the short term, the big question mark remains over JobKeeper, which comes to an end at the end of March. At the time this was put together, it was still covering around 1.5 million Australians. Now, it doesn't talk about the number of companies, I don't believe, just the number of Australians, but that is still a significant number of working Australians that are relying on JobKeeper. There's no doubt that JobKeeper, and complemented by a number of other government initiatives and legislative changes, effectively saved the Australian economy and a huge number of Australian jobs from a much deeper recession and unemployment. However, the program is propping up still a considerable number of companies out there who are just not commercially viable without it. And we are running out of time. Obviously, we're in March already before JobKeeper comes to an end. So at the conclusion of March, it'll be interesting to see what effect that has. We know that it takes time for insolvencies to roll through, so I don't expect to see an insolvency flood at all, but I think we will see a sustained uptick for some time until we get back to pre-COVID insolvency numbers. The other things to take into consideration, of course, the end of rental deferrals and bank support, small business insolvency changes as well. So there's a number of moving pieces here that suggest there could be, what was termed as a September cliff has moved to a March cliff. We're not expecting that flood or tsunami of insolvencies that we're certainly on record as saying there would be. We're in a much better position. However, there's a big bit of uncertainty around what April onwards will look like. As I said, defaults, court actions, insolvency numbers, administrations, ultimately as a minimum need to get back to pre-COVID numbers. And, you look at that from an administration point of view, and we're looking at, that sort of around about 800 administrations a month. There could be some spikes along the way. We don't anticipate that the ATO and ASIC will be overly aggressive, particularly in the first half of this year. However, there have been reports that the ATO are certainly on the lookout for collectors at the moment, which suggests they're probably gearing up to get back into a more normal collection rhythm, a pre-COVID collection rhythm. So really interesting to see what happens at the end of March. As I said, we won't see, 1st of April, a big uptick, but we are certainly keeping an eye out for that June quarter to see an increase across the board of key insolvency indicators. If we look at payment times, this is comparing Jan 20 to Jan 2021, how industries pay their bills. So this is the number of days overdue that they typically pay their bills. So regardless of payment terms, whether it's 7, 14, 60-day terms, it's the number of days past due that they're showing here. So at the far right, you can see the problem industries, the riskier industries. A number of these have been in the top sort of 3 or 5 risky industries for the majority of COVID. Administrative and support services, a lot of that has been brought in-house or turned off altogether. Healthcare is a big one, and I get asked about this a lot. Why, in the middle of a pandemic, a health, a disaster, is healthcare struggling? The fact is, things like elective surgeries and anything non-COVID related has been either turned off or throttled or neglected, and as a result, we're seeing payment times blow out in that sector. Transport, postal and warehousing, of course, this is a huge industry. People start to think of just e-commerce and Afterpay, but the fact is there's a lot more to it than just e-commerce. Think about international shipping and trade, general B2B trade that just isn't happening. A lot of documentation that would be sent around is now moving online to digital signatures, couriers, etc. would certainly be affected by that tremendously as well. A couple of key ones here. Construction has seen a bit of an uptick recently. There's some question marks about that industry, though typically they exist in at the upper end of the risk spectrum. Wholesale trade as well, and of course arts and recreation services. But if you were to compare them to how they were in July, August, September, they're certainly in a much better position. And the fact is, you have the majority of industries here almost back to pre-COVID levels, or at least tracking back to those pre-COVID levels. We're not seeing, the triple figure the triple figure increases that we saw through the middle months of 2020, which is a nice indicator here. So as we see, payment times, best performing industries, mining, information media and telecommunications, and public administration and safety. Look, the one thing to remember about ANZIC industries is, there are plenty of different industries that sometimes fit into a single nominated industry, but as a whole, we're seeing really good improvements almost across the board. And these are really the top performing industries. The worst performing, as we looked at before, I believe healthcare and social assistance is probably the only one that's really in the triple figure increases when you compare it year on year to the same month last year. All of them have certainly seen significant improvements, though we have seen big jumps again, even just out of December to Jan for healthcare and social assistance. This is a really nice stat that we have been utilizing to demonstrate, the effect that COVID had. So this is looking at the value of invoices issued that we are ingesting from various sources. It's not the full the full value of invoices that we're ingesting, but it is a significant part of it. You can see that there are natural peaks and troughs, particularly in December, when there's a huge amount of roaring trade done in the lead up to Christmas, and then there is the December lull thereafter where everyone takes a break, and then it starts to build back up again. Now, you'll notice it's grown year on year. Now, that's in line with creditor watch growth. We've grown significantly over the last 5 years, so this hasn't been normalized out, but nonetheless, it still does a really good job of showing the type of rhythms that we are used to seeing, and then how COVID and the lockdowns and COVID in general affected the value of invoices being issued that we could see in our population. So that COVID lockdowns Australia is covering from March onwards. So you can see that there was the normal December jump, a bigger than usual drop down in Jan. There was a tiny little bump which would cover sort of Feb into March, but then ultimately COVID bit. We've seen a big drop through to May, a little jump in June where the economy started to recover. Sentiment, confidence came back into the market, into the economy, into consumer spending. But we did see the lockdowns in Victoria, and the extended lockdown in Victoria, I should say, really essentially extinguish any sort of hope for economic recovery and trade. And that taken us right through towards the end of 2020, where we started to see an uptick again in December, which is positive to see. That's what we want to see. We want to be trending upwards. I anticipate that will continue. Yes, we've had small lockdowns, 3 days in Brisbane and 5 days in Melbourne. That will not have a significant effect on a graph like this. I also don't believe it will have a significant effect on the overall economic recovery either. People are starting to understand, companies are starting to understand, as frustrating as it is, these lockdowns will happen, and 5 days is certainly much better than experiencing 3, 4, 5, 6 month lockdowns, which we've seen last year, and we are seeing overseas as well. So JobKeeper and the future, what are we sort of seeing in that regard? Food and restaurant industry, currently heavily supported by JobKeeper. Retail, the bricks and mortar without an omnipresent channel, they're really going to struggle if they don't have that presence from an e-commerce perspective, online, through social media, etc. Transport and warehousing significantly affected by border closures, and future travel restrictions will continue to take a toll on this particular sector, not just internationally, but even border-related ones. It certainly slows down their industry significantly. So food and restaurant, again, you can see some nice slides here that come through. Really good increases, and then significantly affected by the lockdowns and the COVID in general in early 2020. Retail, this is a fantastic one because retail have done it tough. Big jump at the end of 2019, obviously affected tremendously by COVID, but then a big recovery towards the end of last year. Transport and warehousing, really no recovery has been seen as yet. Since COVID hit, healthcare, very lumpy, obviously opened a lot back up in the second half of last calendar year. However, we've seen, you know, the closure, sorry, the lockdowns in northern beaches, subsequently followed by border closures, and then of course we've had the small lockdowns in the other states as well. So looking at conclusion notes, and I think, you know, I'm more than happy to, of course, take questions. I will jump in and have a look at whether there's any questions. So if you do want to ask any questions, please put them forward. Of course, if they are if they're better answered by the likes of Harley Dale, our chief economist, I will pass them on to him, and I will get those shared later on as well, either on the blog or when we send an email around with the recording and the slides. I encourage you to ask questions. I think that should say 2021. We are in for a very bumpy 2021. There's still uncertainty out there. While it says the word of the year could well be uncertainty, I'm still sticking to what I said at the beginning, is positivity. There's just an unknown out there. We don't know what JobKeeper coming to an end will do. We don't know what how the small business restructuring will be accepted and used. We don't know what the recovery will be like and the rollout of the vaccine. But in my mind, while it's going to be bumpy, I think overall we're going to see significant improvements over the course of the year. Starting platform is certainly higher than we all expected, particularly throughout the middle parts of 2020. Be aware that the divergence in economic activity between sectors of the economy and between states and territories will be wider than we would experience in a normal year. A great way to think about that, we will certainly have a multi-speed economy in place at the moment. We've seen, those that were fairly unaffected from a COVID case perspective for example, WA and Queensland, they were certainly trending much better than New South Wales, who was kind of sitting in the middle for a long period of last year, and then of course Victoria further down the scale. I think what we're seeing now is Victoria, slowly starting to recover. Queensland's recovery is going to be much slower, and they're really still hurting from extended border closures, and their tourism industry in particular simply can't be supported by domestic tourism. And there'll be various pockets to look into, whether that is geographical or industry related. That will certainly be of interest through the next 6 months. China, Harley has flagged this. Our relationship with the world's most populous nation, our biggest trading partner, is fractious. That doesn't look like changing in a hurry. We've seen plenty of export bans into China on Australian goods, which is certainly hurting specific industries. We're now seeing recently calls for bans on promoting Chinese students from going to Australia from an education perspective, and the education market is an industry is certainly doing it tough. So they're very reliant on those international students that simply can't get in there, but there's plenty of discussion around how they get them into Australia from a COVID safe perspective. New residential construction, retail and wholesale trade, and hospitality of all sectors are examples of sectors that should shine. And I think shine is relative. They will grow from that very low base that they are on, but plenty of people are cashed up, sick of making their own breakfast, lunch and dinner and cleaning up after themselves. And we've seen, local cafes, suburban-wise, supported really well through the pandemic. And we're starting to see restaurants and then in general, the CBD hospitality sector start to grow and thrive, as well as people start to go out from an entertainment perspective again, which is really good to see. There will be a considerable number of bankruptcies and insolvencies as we move through the year, but no flood. we have to get back to normal numbers. If you compare insolvencies, even in January, they were still down significantly on January 2020. Overall, there's probably 3,000 to 4,000 normal insolvencies that would happen in a pre-COVID year that didn't happen in 2020. Ultimately, they will need to be processed. They won't just simply not occur. So keep an eye out for that. Ensure that you are monitoring all of your customers through Creditor Watch, of course. We will provide email alerts to let you know that there's been a significant change, and that could be a payment default, it could be a court action, it could be an insolvency, it could be a small business restructuring insolvency notice. We are sending them out, though there's only been, I believe, 19 to date, and one small business restructuring specialist appointed. If I've got that wrong, please let me know. But the importance is you want to be able to take advantage of real-time notifications and data, and that's certainly where we spend a huge amount of our time prioritizing so that we can get those alerts and those reports and those credit ratings to you in a timely manner, so they are of the most value that they can be. So look, that ultimately takes us to the end of the presentation. I will just jump in to see if there are any questions. We do have a question here around the breakdown of data. Is it possible to break down some of this information into state-based information as a smaller business with no representation outside of our state? We're often not sure whether states such as Vic heavily sway the information due to lockdowns. Yes, you can actually jump into Creditor Watch, which I will do now. I'll show you. If you jump into creditorwatch.com.au, you can see our business risk review market insights. Click through to that, and what you will see, sorry, this is working off my phone, so it will just take a second. There's plenty of data to get through. What you will see is high level numbers being shared, but then you can specifically go into administrations, for example, look at it from an industry breakdown or state breakdown. So you can compare New South Wales to Victoria, for example. So that hopefully will answer that question. And I encourage you to jump in and take a look through the data that we do have in here. You can see court actions are certainly down across the board, particularly versus the same period 12 months ago. Payment trends generally have gone up over the last 12 months, and we've seen an increase in Jan, which is not unexpected. Jan is generally higher than other months because people aren't around to collect and people aren't around to pay. But you can click around in certain industries and see how various industries are performing. So healthcare and social assistance is a good one there to look at. That takes us to the end of the presentation today. So I wanted to thank you all for joining me. Apologies if you were expecting Harley. You just had to make do with me today, but we will certainly be getting him involved in the future again. So thank you, everyone. Have a great weekend.